Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for November 2nd, 2020. Please see our disclaimer for important information. Well, we certainly do have a lot to talk about this week, not the least of which is the election, which is going on right now, and obviously will have a big influence on what happens in terms of policy and rhetoric and expectations and things like that. I don't want to wax political too much, just to highlight that the current polls tend to suggest a Biden victory and a small Senate majority for the Democrats, which does not lend itself to a very robust progressive agenda, but at least that's where things stand here on the eve of the election. With having said that, the markets did exhibit a lot of turmoil last week, and this is symptomatic of volatility that I think we all knew was coming. I certainly did. We had kind of a reversal, of course. I think near-term risks that we've been kind of musing about for some time now kind of finally caught up with the financial markets last week. And I think before we get into the data, I think just in sum, I think stock prices will be kind of almost led by coronavirus news after the election, and it's going to be driven a little bit more like in this uneven economic data that I think we can expect to see over the next few months. Obviously, we're waiting on a new fiscal stimulus package, which I think by and large will probably come early next year, as well as an eventual vaccine. And so when we get those types of things, certainly the stimulus package and the vaccine, I think that will lay the groundwork and the pavestone for future equity outperformance. But I think right now we're just going to have to kind of hunker down and get through the next several months. With having said that, the Dow Jones index was down 6.5% last week. S&P was down 5.6%. The NASDAQ was down 5.5%. Now, this was the worst week that we saw since March, and worst month since March. The cataclysm of several, increased volatility and tensions in the markets and rising coronavirus cases all came to a head last week. And it looks like the early indications are for a bit of a rebound this week as the election is ensuing. But we also had an increase in 10-year U.S. Treasury yields up to almost 90 basis points, so clearly moving out of its band. When you look at fixed income, is not a broad-based kind of flight to quality, but really more of a symptomatic of the correction in equities. So the volatility index, otherwise known as the VIX, was 40. So that was a notable spike there. And obviously we had multiple reasons. We had coronavirus cases setting records, and we'll talk about that in a few minutes. We had different types of stocks that didn't perform. There's still this feeling of some kind of turmoil after the election that's going to get thrown into the courts, so on and so forth. And then this growing realization that the market is going to likely have some struggles without a new stimulus package. And, we've seen kind of lateral impacts on things like oil prices, which were down notably over the last week. And in fact, are down, oil, WTI crude is down 11% for the month on fears of lower demand and increasing supply, and the fears of lockdowns and what that's going to do to a lot of different things, frankly. But just looking at the monthly data for October, the S&P was down about 2.8%, and the Dow Jones was down about 4.6%. NASDAQ was down about 2.3%. Russell 2000 And we'll talk about small caps in just briefly. They were up 2%. So we're getting to witness a little bit of a pickup in small caps. Now, typically you see in a recession that the small caps are going to get pounded the most, which was certainly the case. But interestingly enough, at a point where we've seen some turmoil in the larger caps, small caps have kind of outperformed lately. Now, year to date, the S&P is up slightly, about 1.2%. The Dow is still down, notably about 7.1%. NASDAQ, again, the technology stocks, these FANG stocks that we've been talking about for months, have carried the NASDAQ higher by the tune of 21.6% for the year. Small caps are down about 7, almost 8%. Now, looking more broadly, the MSCI EFA, which is a kind of an international stock index, was down about 4% for the month and is down 12.6% for the year. Emerging markets were up slightly for the month, and that's where the best value of equities on the planet exists. They just lack a catalyst right now, and they're slightly below break even for the year. We've talked about volatility. If we go over to bonds, and there's some things going on in the bond market, but the Barclays aggregate index was down slightly for the month, but is up about 6.3% for the year, which is about 5 percentage points higher than where high yield is returning so far this year. And we talked about crude, which is down now about 41% for the year. Gold prices were a little bit mixed. We're still seeing some consolidation here, pretty close to the $1,900 an ounce level. Gold prices are up about 23.4% for the year. Dollar was mixed for the month of October, and it remains down about 2.4% for the year. And then we talked about the 10-year Treasury. Interest rates have moved up a little bit, and so we've clearly seen, a move in interest rates, and I think when we get down to our observations, I think we're going to continue to see that, and perhaps even see like a full 1 percentage point, a one handle on interest rates, perhaps by the end of the year. But the big news last week was GDP, the economic reading, kind of the first reading here, if you will, of the third quarter. And so let's talk about that for a few minutes, because there's definitely some read-throughs here and some things that I think we can take away from it, and some things that we'll need to certainly continue to monitor. But having said that, the U.S. GDP, or basically the U.S. economy, was up 7.4% in the third quarter versus the second quarter. And on an annualized basis, that's 33.1%. So big number. We knew it was going to be a big number. It's coming off a really big drop in the second quarter. So we had a quarterly 9.1% decline in the second quarter, which is a negative 31% annualized. So again, we're recapturing some, but we're still 3.5% lower in aggregate economic level than we were at the end of last year. And so, it's still expected. It's going to take us several years to kind of close that output gap, so to speak. Now, the real read-through, there's some real positive things in this, and one of them was spending. Consumer spending grew at a 40.7% annual rate, and spending on durable goods rose at an 82% rate annualized, and spending on services really kind of shifted over to goods. So we still see a lot of trouble in the service-related industries, and these are restaurants. These are, what you might think. And again, if you're having rising coronavirus cases and new restrictions being placed on your service economies, that number is going to likely remain weak. But goods spending is definitely higher. So, and services is important because it represents 60% of our economy and about 85% of our employment. And we know that a lot of small businesses are service companies, and we know that a lot of workers have been displaced, and a lot of those workers are going to see some of these supplementary benefits that they've been receiving expire at the end of the year. So that's something that we're absolutely going to have to monitor related to what happens in the economy at the beginning of the year. And also, as it relates to what happens in Washington with regard to temperament towards a incremental stimulus package. But the internals of spending. So domestic investment, we saw home building spending rising close to 60%. Business investment, which was a really positive takeaway from the GDP report, that rose at over 20%. That's really positive. Again, CEOs that have been more positive than consumers are now putting their wallet where their mouth has been and actually spending. So spending on structures was down about 14.6%, and this has a lot of influence from commercial real estate and the energy industry. But one thing that we need to watch is kind of that second derivative factor here. So while the consumer numbers were really good, with the exception of retail and home residential home building spending, growth in August and September, the last 2 months of the quarter, were slower than prior months. So we're seeing a deceleration, even if they're still positive. So we definitely want to watch that. So and I've been reading up on Congressional Budget Office, which does its own projections, and the CBO is designed to be an independent, nonpartisan entity, providing economic forecasts and basically scoring legislation. But they now project 20-25% GDP. Again, this is looking out several years on the horizon, to be 3% lower than what they thought their projection was going to be pre-pandemic. So our trajectory and recovery rate from the pandemic is expected to be lower overall. And basically, the longer we have to wait for stimulus, the longer we have to wait for a vaccine, the greater the risk is for all of this. And I think that there's some investors have been overly optimistic, I think, in some cases. Obviously, we've rebounded strongly in the hopes of medical advancements and vaccines and things like that. Deborah Birx was on the wire yesterday as having said, we're going to have to wear masks for multiple months, and there's no vaccine that's right on the near-term doorstep. So the market has kind of ignored bad news, like the signs that the virus is spreading and areas of global economy might shut down, and that the fiscal stimulus might be less likely, especially in 2020. And then, but at the same time, we've seen an advancing in markets and running up to the election, and then kind of looking past the prospects, at least until last week, of some other negatives that might be on the margin, like higher taxes in a Biden presidency. But in any case, markets will continue to be driven by the pandemic and the outcome of the elections. I'm pretty certain of that. I'm not sure that we're going to have a return to normal activity until we get a vaccine and more effective treatments, even if with the rise in case volume that we've seen for the virus, we've had a mitigated death rate. But even still, we're not going to get back to normal activity until we have a vaccine. And that's not to say that governments may impose their own restrictions, but I think you're going to find businesses doing their own, even in the absence of some government restrictions. You might see businesses that might close or impose restrictions on their own. But I think in large measure, kind of reflective on the consumer data in the GDP report, that the easy part of this recovery is past us, and I think what we're going to see is perhaps some choppy data in the next several months. And the odds are high, like I said, that we're going to have a new fiscal stimulus package early next year, and that will obviously have an impact on GDP. Now, that's not to say that all of this is negative. It's just saying that the data could be choppy and uneven. Positive takeaways from other reports last week, the jobs report, we had Jobless claims at the lowest level that we've seen in the crisis here thus far. We talked about GDP. Personal income was actually up 0.9% in September, and personal spending was up 1.4%. And sentiment indexes and the Chicago Purchasing Managers Index were both ahead of estimates. And the fact that even in this third quarter reporting period, which I haven't said anything about, over 80% of the companies have beaten their forecasts, and with almost 2/3 of the S&P index reporting, while they've beaten the earnings are still down about 12.5% year over year, but that's much better than had been forecast. And so, again, it's not all bad. I just want to kind of cushion the sentiment a little bit by just saying that we've done a lot of heavy lifting in the economy, and the path forward is going to be perhaps a little bit choppy until we get vaccine, until we get a real good shot in the arm here with stimulus. And again, having said that, once the stimulus package is approved in Congress, then there's a transmission delay, right? You have to get the checks delivered, and so there's probably at least another 4 to 6 week delay if part of that package is actually sending checks to people. So we need to keep that in mind as well. So anyway, election, this is going to be a record turnout. I know that we've had 85 million ballots already cast. I know here in Texas it's been an absolute barn burner. We've had more votes cast in early election than I think we had cast in total back in 2016. Now we've seen a lot, 55 million ballots nationwide were sent by mail, and we've already had like 230 some odd election-related lawsuits filed. So I'd say sit back, grab your popcorn, because this may take a little while. And if it does, I think it could add to the volatility in the market. But other things this week that we're looking for, obviously we'll get an employment report for November. Looking forward to that. And also we get the Federal Reserve, which meets this week here on Wednesday and Thursday, and will likely just simply hold the line on these ultra low interest rates. And we've talked about the economy a little bit. So move on from there. Let's see, other read-throughs in the economy. So small caps, I mentioned before. In third quarter, S&P 600 stocks, which is a small cap portion of the S&P 1500, the earnings were down 72% year over year. That's phenomenal. And the S&P 500 earnings were down about 19, and that may even turn out to be better. But you can see the huge disparity, and probably the reason why small caps have greatly underperformed this year. But since the end of June, really on the eve of the third quarter, beginning of the third quarter, we have seen a shift in analyst expectations, and now the expectations are like up 30% from where they were, and obviously what we've been talking about, this kind of euphoric influence here of people kind of looking past some of the near-term issues and looking ahead towards stimulus and things like that. That the expectation now is that you're going to have a earnings rebound in small caps in 2021 to even greater than where they were in 2019. So we've already seen a move in some of the small cap indices, as I mentioned on the outset. But with that in mind, that's one of the things that we're kind of looking at internally for our portfolios, is the allocation to small cap. Let's see, a couple other things. Dividends. What's really interesting is we've had a lot of dividend cuts in the wake of the pandemic, and we've seen some of those actually be restored. But the index, the yield in the S&P 500 Dividend Aristocrats Index is like 2.7%. Now contrast that against a 10-year Treasury, which is 0.9%. Huge differential there. and 70% of the S&P 500 actually has dividend yields that are above that treasury yield right now. But the while the S&P index is up slightly this year, but it's up almost 7 percentage points above the broader S&P 500, mind you, is up almost 7 percentage points in terms of return over the dividend aristocrats. So that's really interesting, considering that over the last 40 years or so, that of roughly 40+% of the total market return has been generated by dividends. So that's something to take stock of, that the dividends really just have not been working that well. And then on the bond side, something that I pay a lot of attention to, we've had a lot of issuance in the fixed income markets lately. In fact, we've had 360 billion of speculative debt. Now, this is really more high yield, has been issued since the start of the year, and that's above any total that we've ever seen. Amazing. And then the high yield bond the average high yield bond has a debt to EBITDA. Again, this is their ability to pay interest. Debt equal to EBITDA of 6.1%. Now that's a huge debt burden. Just think. So basically your operating profits, your debt is 6.1 times more than that, and that's the highest level that we've ever seen. So I worry about defaults, but Moody's has come out with some data, and it was reported in the Wall Street Journal last week that there haven't been that many defaults. In 2008, 2009, the high yield speculative default rate was about 14.7%. That's a high number. Now, right now, that number is about 8.5%, according to Moody's. And they expect that rate to kind of perhaps peak, at about 11.1%. But I would say that the risk is that number's higher. And what does that do for the fixed income market? That's what we don't know yet, and where that number is going to shake out, and frankly, where that number is going to look like, what that number is going to look like for municipal debt, for municipal entities that are going to be struggling in their own right. And so this number is just for corporate and commercial debt. The muni debt rate could eke up as well. A few comments on COVID, just kind of putting a wrapper around some of this new data that we're seeing, and some things that are kind of interesting on the margin. But we've got 9 million cases. On Friday, U.S. topped 99,000, almost 100,000 cases on a single day. Total is now 9 million, and we've seen a 7-day moving average. Again, you can see this data in visual form in our charts of the week package. But we've had mitigation in the death rate, so we're getting better at treating this once we test. And I think some of these case numbers are a function of increased testing too. But worldwide, we've seen 46 million that have been infected, and about 1.2 million that have died. So again, we're starting to get a little concerned heading into the winter months, the cold weather months, where people are more inside, together, which has been shown to increase the transmission of the virus. So that there's people that are, beginning to get a little bit worried about hospital bed capacity, and so on and so forth. And then obviously, and you can clearly see this in a chart we have in the charts of the week package, that the Europe second wave is really accelerating. Spain, we've got an emergency situation. France is clearly the worst, in the worst situation of all of Europe. And then Germany, you've heard some additional restrictions and moratoriums on non-essential businesses. Italy, and they're going back into restrictions. And then, so France and Germany lockdowns. So you've just seen a lot of this retrenching, and I think it's going to have an impact on global trade. It's going to have an impact on global economic growth, and then to the extent that we have U.S. firms with international exposure, it's going to impact them as well. And then the other thing I saw, and this is out of the Wall Street Journal, but I also saw it in Sandy Leeds' package of information, was the fact that immunity might be wearing off. And it's really interesting that there was a study, it cited a study in England of like 360,000 people that said the percentage of people testing positive for the antibodies declined by like 26% between June and September, the end of September, and that basically it suggests that we don't know if antibodies give us immunity, and it just kind of reinforces this notion that herd immunity, as it's called, is likely not going to not going to happen, and that we're just going to have to wait for a vaccine. And so there's a lot of speculation on when we're actually going to see that for widespread use. So let's get into kind of observations and themes, and then we'll close out today. But I go back to consumer confidence remains a bright spot. We have a strong consumer now. We don't know how strong the consumer is going to be after some of the programs in place, unemployment and stimulus checks, the pandemic PUA assistance for some folks expires at the end of the year. We don't know what that's going to do to consumer spending. In my charts of the week, there's a couple of conflicting charts related to anticipated holiday spending. Again, we don't really know how that's going to track. We just know that more of it's going to be online. And then on the corporate side, the takeaways from the third quarter earnings reports is that we've had less negative results, and that's really positive. So another takeaway, that the economic recovery might tail off here in the coming months, and then I mean, at least until we get a new fiscal stimulus program next year. And so I think the one thing we're going to have to build our expectations around is that fourth quarter growth is going to be pretty blah, pretty meh. It's going to be about maybe 3 to 4%, I think. And then we don't know what the new wave of coronavirus cases is going to do to impact economic growth, but I've just got a feeling it's going to be negative, at least in the next 3 to 4 months, and we may have to wait actually until the second quarter of 2021 to really kind of get past some of this chop here. I do think with more bond supply and higher expected inflation that Treasury yields are going to move up a little bit more. We've got expectations of better growth next year, and the prospects of this fiscal stimulus package whenever it comes. We haven't talked about this, but clearly if you have a Biden victory, you're going to have higher taxes, and I think that is not in the calculus right now for folks, but it will be, and I think it will be probably February-ish. People will start to really begin to think when Congress gets back in session and you start to see these legislative priorities being laid out, that you're going to get more corporate taxes, so an increased burden on companies and earnings, and regulatory scrutiny will probably increase as well. So what it means is that like this V-shaped recovery might be, the tail of it might be a little wiggly, if you will. But I'd like to close actually on a really more positive note, because this is something that was in Barron's. So over the last 94 years, we know the average return in the stock market annually has been about 10%. And we know large caps return about 10.2%. Small caps over the last 94 years have returned 11.2%. Bonds have returned 5.2%. But in 60 rolling 35-year periods, so 60 of those incremental 35-year periods, investors earned in the stock market about 10%, 80 7% of the time. And even over the last 30 years, you've earned that about, more than almost 3/4 of the time. So, the history is on our side here. We've seen a lot of turbulence over the last year, but history is clearly on our side. And I think these trends are beginning to play them out. We talked about the shift into small caps that we're looking at. And I think this is kind of what the market's thinking about too. You're going more from active management into passive investments, and you're kind of increasing slowly your international exposure again, and in emerging markets, which, as I said before, have clearly the best value in the market right now. And I think, if you look at, beyond the near-term struggles, even beyond the risk of having increased taxes, that, with this vaccine, I think the vaccine and the widespread dissemination of it will create a tremendous catalyst for stock market growth. I think there's so much pent-up liquidity out there that's waiting for that moment that I think a lot of it's already priced in, but you're going to get a real shot in the arm, no pun intended, when we have clarity on that. So I really do see positive and encouraging signs on the horizon. We've just got to get through the next few months of kind of uneven data, but I'm entirely optimistic long term, and really, kind of excited for, kind of what the long term and what the intermediate and long term holds for investors. My comments, and look forward to visiting with you again next week. And welcome any feedback you might have at the information you see on your screen. Hope you have a wonderful week and stay safe.